Hey there, folks. Today, we're diving into the latest jobs report and what it means for the economy. Now, I know what you're thinking. Another report? But this one's got some interesting twists and turns that are worth exploring. So, buckle up, because we're about to take a deep dive into the world of employment statistics and economic trends. First things first, let's talk about the numbers. The Bureau of Labor Statistics is set to release its non-farm payroll report for July, and the consensus is that it'll show a modest pickup in hiring, but with stagnant wages. Economists are predicting around 83,000 new jobs, which is a significant jump from June's 57,000. The unemployment rate is expected to stay at 4.2%, which is pretty stable. Now, here's where things get interesting. The U.S. is in the middle of a complicated economic backdrop. We've got ongoing tensions with Iran, which is keeping energy prices elevated, and inflation is still above the Federal Reserve's target of 2%. Wages are struggling to keep up with the rising costs, and that's a big deal. Diane Swank, the chief economist at KPMG, points out that average hourly earnings are expected to rise by 0.3%, which is a 3.5% increase from a year ago. That's not a huge jump, but it's a sign that the cooling in wages might be hitting a bottom. Swank also mentions that inflation is a major challenge, and it's accelerating again due to the conflict in the Middle East. Now, here's the thing that many people might not realize. Wage growth has been gradually weakening over the past few years, and it fell below the inflation rate in April and May because of the Iran war. But since then, energy prices have come down, and that's giving us a bit of a breather. Swank is expecting an above-consensus 100,000 jobs, which is a bold prediction. She believed that firms are starting to loosen their purse strings and hire again, which is a positive sign. Bank of America's economist, Shruti Mishra, agrees and says that a report in line with their forecast would signal a healthy labor market. Mishra highlights that education and health services will likely lead the job gains, and leisure and hospitality might see a modest rebound after June's decline. These sectors are often seen as indicators of consumer spending health. Now, let's shift gears and talk about manufacturing. Recent survey data shows that employers in this sector are increasing hiring for the first time since September 2023. Factory activity is rising at the strongest pace since 2022, and that's a positive sign for the economy. Gus Fauché, the chief economist of PNC Financial Services Group, notes that manufacturing employment has increased in 4 out of 6 months this year, despite the industry losing over 300,000 jobs between 2023 and 2025. He's forecasting modest job growth in the sector throughout 2026, which is a promising outlook. But here's the catch. The Trump administration recently imposed new tariffs on 60 economies, and 25 states have sued to stop them. This could have an impact on the labor market, as it might affect hiring and economic growth. Fauché believes that the labor market is solid this year and is better than it was last year. He points out that job growth is broadening across sectors, with healthcare accounting for only about 11% of total job growth this year. That's a significant shift from last year, where employment outside of healthcare fell. Now, here's the real kicker. A positive jobs report could set the stage for a Fed rate hike, potentially as soon as September. The central bank is heavily focused on price stability, and a rate hike could reinforce inflation as the bigger issue. The futures market already shows a more than 50% chance of a September rate hike. However, not every economist is convinced that Friday's report will be positive. Vanguard senior economist Adam Schickling is forecasting just 18,000 jobs, which is well below the consensus. Their data, based on 401k retirement plans, shows near-zero employment growth in July, which translates to around 9,000 jobs when scaled to the entire U.S. labor market. So what does all this mean? Well, it's a complex picture, and there are a lot of moving parts. The economy is facing challenges, but there are also signs of resilience and growth. It's a delicate balance, and the future remains uncertain. But one thing's for sure, the labor market is a crucial indicator, and it's worth keeping a close eye on. In my opinion, the key takeaway here is that the economy is still finding its footing. While there are concerns about inflation and wage stagnation, There are also positive signs in manufacturing and leisure and hospitality. It's a mixed bag, and the Fed's decisions will play a significant role in shaping the future. So, stay tuned because the economic story is far from over.